Investing doesn't have to require a large sum of money to get started. With just $100, you can begin building your financial future and make your money work for you. Whether you're new to investing or looking for ways to maximize a small budget, there are plenty of opportunities that allow you to get started with minimal risk. In this guide, we'll walk you through simple steps and strategies on how to invest wisely with just $100 and set yourself on a path toward growing your wealth. Today, we will talk about how to start investing with just $100. So before we start, make sure to hit the like button and subscribe to my channel. 1. Breaking the myth: you don't need thousands to start investing. Many people believe you need a lot of money to start investing, but this simply isn't true. Thanks to modern technology, online platforms, and the rise of fractional shares, you can begin your investment journey with as little as $100. In the past, high brokerage fees and minimum investment requirements made investing inaccessible to the average person. But today, beginner-friendly platforms like Robinhood, Fidelity, Sophie, and Charles Schwab allow investors to buy fractions of popular stocks, meaning you don't need to pay $3,000 to own a share of Amazon. Micro-investing apps like Acorns and Stash even allow you to invest spare change. What's important is building the habit of investing regularly, even with small amounts. Starting early allows you to benefit from compound interest, which means your money grows faster over time. Don't let the size of your initial capital discourage you. What truly matters is consistency, education, and discipline. Even a $100 investment can be the seed that grows into thousands of dollars over decades. Your first investment is more about developing confidence and experience than making massive profits. The most successful investors didn't start rich, they just started early and stayed committed. 2. Choosing the right investment platform for small budgets. When you're starting with $100, selecting the right platform is crucial. You'll want one with low or zero fees, fractional shares, and user-friendly interfaces. Platforms like Robinhood, Fidelity, Charles Schwab, and Webull are all popular choices for beginners. These allow you to buy stocks without commission fees, which means more of your money goes directly into your investment. For those who prefer a more hands-off approach, robo-advisors like Betterment or Wealthfront can be ideal. They automatically invest your money in diversified portfolios based on your risk tolerance and goals. Some apps like Acorns round up your purchases and invest the difference, making it even easier to begin without thinking too much about it. Before opening an account, compare features like minimum deposit requirements, available investment options, stocks, ETFs, crypto, etc., educational tools, and account types. Make sure the broker is SIPC insured and regulated by FINRA or the SEC. Starting with the right platform not only helps you grow your money efficiently, but it also introduces you to critical tools and resources that will serve you well as your investment knowledge expands. Always read reviews and take advantage of demo accounts if available before committing your funds. 3. Deciding what to invest in with just $100. With only $100 to start, your choices might seem limited, but you can still invest wisely. The key is to prioritize diversification, even if on a small scale. One of the best ways to diversify with limited funds is through exchange-traded funds, ETFs. ETFs are collections of stocks or bonds that trade like a single stock. A good beginner-friendly ETF is SPY, which tracks the S&P 500, offering broad exposure to top U.S. companies. Alternatively, you could consider fractional shares of high-performing individual stocks like Apple, Microsoft, or Tesla. Many brokers now let you invest as little as $1 into any stock. If you're interested in a particular industry, like tech, healthcare, or clean energy, there are thematic ETFs designed for those sectors. Another smart option is a dividend-paying stock, which provides small, regular income even while your investment grows. Avoid penny stocks or speculative assets. Your first $100 should be in something relatively stable and easy to understand. Always do your research using platforms like Yahoo Finance or Morningstar to understand what you're buying. The goal with your first $100 isn't to get rich overnight, but to lay the groundwork for disciplined, informed investing. 4. Building a mini investment strategy. Even with $100, you should build a mini strategy to guide your decisions. Start by asking yourself a few questions. What is your goal? Are you investing for retirement, a down payment, or just to learn the ropes? Next, determine your risk tolerance. If you're young and have a long time horizon, you can afford to take more risks. If you're conservative, prioritize stable investments like index funds. With $100, it's wise to dollar cost average, which means investing small, fixed amounts regularly instead of trying to time the market. Though your initial amount is low, you can commit to adding $10, $20 monthly. Over time, this snowballs into a substantial portfolio. Your strategy should include diversification, investing across sectors, a watch list of stocks you're researching, and a review schedule, perhaps once a month, to check performance and make adjustments. This creates a disciplined habit that translates to larger portfolios in the future. Set up automatic investments if possible to avoid emotional decision-making. Your $100 investment isn't just financial. It's a tool to teach you how markets work, how to build consistency, and how to manage risk. These skills will pay off tenfold when you're investing with larger sums. 5. Fractional shares, the best option for beginners. Fractional shares are a game changer for investors with limited capital. Traditionally, if a single stock cost $500 or more, investors needed to buy a full share. Now platforms like Fidelity, Robinhood, and Schwab let you buy a fraction of a share for as little as $1. For example, if Amazon is trading at $3,000 per share, you can still invest $10 and own 1/300th of a share. This means your $100 can go towards some of the world's best-performing companies, even if their share prices are high. Fractional shares also enable easy diversification. You can spread your $100 across 5 or more companies or ETFs instead of putting all your money into one. This reduces your risk and provides more balanced exposure to the market. They're especially useful for building portfolios that mirror indexes or ETFs. Over time, as you contribute more, your fractional shares grow proportionally. It's the easiest way to build a portfolio that looks like a millionaire's without being one. 6. Avoiding common pitfalls with small investments. When investing small amounts, it's tempting to make big bets, hoping for quick profits. But this mindset often leads to losses. Many beginners fall for hype stocks, chasing sudden spikes without understanding the fundamentals. Social media influencers or pump-and-dump schemes are especially dangerous when you're just starting out. Another common mistake is trading too frequently. Every trade has a cost, even if commission-free, in the form of taxes or poor timing. Instead of gambling, focus on long-term investing, buying and holding quality assets that grow steadily over time. Another error is neglecting research. Just because you're investing a small amount doesn't mean you should invest blindly. Even with $100, read earnings reports, understand company missions, and learn how to interpret price charts. Emotional investing, panic selling during a dip or greedy buying after a rally, is also dangerous. Set goals, create a plan, and stick to it. Lastly, avoid platforms with hidden fees or poor user interfaces. Choose brokers that prioritize education and transparency. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.